Hi guys, this is lesson 11 of the Trading 101 course. In this lesson we're going to be talking about leverage. Let's get straight into it. Hi guys, this is Enny, aka the Knock Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, hit that subscribe button, and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram at the Knock Trader on all social media platforms. And if you check the description section below, you'll see a link to my mailing list and my Discord group, which is a chat room for all like-minded traders. Now, if you haven't seen lesson 1 to 10, I'd advise you that you go watch them in order from 1 to 10 and then watch this one after. Let's get straight into it. So one of the most wonderful and potentially scariest things about trading through a spread betting or CFD account is leverage. Now, in the simplest terms, leverage is all about how much capital you have access to based on how much money you put up. So the best way to really explain leverage is through a mortgage analogy. So if you have a 5% deposit for a house, then the bank could potentially lend you 95% of the rest of the value of the house. So that means that you have access to a property that's worth 20 times the value of the capital that you put up. So in this case, in this analogy, if you had 15k and the house is worth 300k, the bank would lend you the rest of the 95%, and in turn you've got a leverage of 20 to 1 because you've only put up 15k, but the ownership, the value of the house is worth 300k and you have access to it. So that in the same way, you may have access, you get access to 95% more, 20 times more leverage based on the capital that you put up. You can do the same when trading CFDs or spread betting. So in the analogy in this section below, when it comes to major currency pairs, you get a leverage of 30 to 1, and that means a margin of 3.3%. So the leverage is all about how much money you get access to based on how much money you put up. So for every £1 you put in your trading account, you can trade as if you have £30. So this is a double-edged sword. That means that you can make way more money with a smaller amount because you can trade like you have more money than you do, but that also means you can lose a lot of money really faster if you trade like you have more money than you do. So it's a double-edged sword. You have to be very careful with leverage, and leverage and margin are intertwined because leverage it just talks about how much capital you have access to based on how much you put in your account, and margin is just all about how much money you account. So they're saying the same thing but in different ways. So if you put £1 in your account, you can trade as if you have £30. And obviously, as I spoke about in the previous lesson, the margin requirement differs based on the asset class. So if you want to check that lesson again, I gave you a table of all the different asset classes and the different leverage and margin requirements based on each asset class.